I'm Tom Narrital, President of UBS Americas and Co-President of UBS Global Wealth Management. On behalf of all my UBS colleagues, Happy New Year, and thanks for joining this special event. Today, I'm excited to welcome you to a discussion about 2021 and what investors and market watchers can expect for the months ahead. We're only a week into the new year, and the topics that dominated last year's headlines remain front and center. The pandemic, the ongoing economic recovery, and as we saw yesterday in the startling images from Washington, a contentious and a volatile political environment. I know I joined many of you in watching yesterday's events unfold with a mix of alarm and anger and sadness. This morning, I sent a note to all of my UBS colleagues in the United States sharing those feelings. I talked about how our democracy can be messy sometimes, how it can move more slowly and be more divisive than we'd like, and how some say it's just too confusing and too complex. But I also said that we must never let those frustrations deteriorate into the kind of ugly, unrecognizable, and tragic actions that we saw yesterday. Like many of you, I was pleased to see that Congress was able to work late into the night to fulfill its constitutional duty to evaluate and to certify the election results. And today, as we woke up to a country whose strengths and ideals were once again tested, we're again demonstrating that most American have characteristics: resilience. And as we look ahead, there's also a sense that significant change is on the near-term horizon, whether it's the potential for a renewed sense of compromise and bipartisanship in Washington, D.C., the continued rise of exciting new technology, and especially the impact of the global COVID-19 vaccination effort. At the start of what UBS is characterizing as the year of renewal, our goal is to help you understand what these issues mean for your families, for your businesses, and for your portfolios. Today, we're going to first speak with two of my UBS colleagues about their outlook for 2021. Salita Marcelli is the Chief Investment Officer for the Americas region for UBS Global Wealth Management. As our regional CIO, Salita leads a team of more than 50 research analysts dedicated exclusively to serving the needs of individual investors. And Barry Gill is the Head of Investments for UBS Asset Management, where he leads a team of 450 investment specialists overseeing more than $700 billion in assets across traditional and alternative asset classes. We're then going to spend the second half of our conversation taking a deep dive into a topic that more than any other issue is likely to dictate how quickly our country and our world emerge from the COVID-19 crisis: the rollout of the vaccine. For that, I'm really excited to be joined by Dr. John White, the Chief Medical Officer of WebMD. Dr. White leads WebMD's efforts to develop and expand strategic partnerships that help to create meaningful change around important issues of public health. Prior to WebMD, Dr. White served as the Director of Professional Affairs and Stakeholder Engagement at the U.S. Food and Drug Administration's Center for Drug Evaluation and Research. And in addition to being an internationally recognized expert on the development, the review, and the safety of drugs and vaccines, Dr. White is also a board-certified internist who continues to see patients in Washington, D.C. and in Maryland. We've got a lot of ground to cover, so let's get right to it. First, Salita, I'll start with you. We're seeing disputes about the election resulting in violence. We see spikes in COVID cases worldwide, and we see economic data that continues to be somewhat mixed. But as I mentioned, in my introduction, you and the other experts in the UBS Chief Investment Office see 2021 as a year of renewal. So tell us why your outlook's so positive.
Great. Hi, Tom, and good afternoon, everyone. You're certainly right that the near-term uncertainty remains, but we maintain our positive outlook for a few reasons. First, and most critically, we are optimistic on the wide availability of vaccines by the middle of the year. The Pfizer and Moderna vaccines are being rolled out in the US, UK, and parts of Europe, and the AstraZeneca vaccine has been approved in the UK. Vaccines push us closer to economic normalization even if the initial rollout has been slower than initially anticipated. Second, we believe that expansive fiscal policy will continue to provide a key support for the economy as the vaccines are rolled out. Right before the new year, as we all know, Congress was able to pass a $900 billion COVID relief bill that provides aid to both small businesses and households. This aid is already being dispersed into the economy. And with Democrats taking control of the Senate, we think additional fiscal policy is likely to come later in the first quarter or early second quarter and should outweigh any increase in taxes, which we believe could be delayed until 2022. So to be sure, both the spending and tax increases will be scaled down versions of what was proposed on the campaign trail, given the very slim Democratic majority and of course the presence of the moderate Democrats. And the third reason why we are positive is because we believe that monetary policy will remain accommodative this year. Inflation is likely to stay below the Fed's 2% target as large portions of the inflation basket, like shelter, continue to experience disinflationary pressure. And also labor market slack is likely to persist well into 2022. So with this in mind, we believe that the Fed will be very hesitant to raise interest rates anytime soon. Before I turn it back to you, Tom, I just want to take a quick moment to address the question of whether or not risk assets are approaching bubble territory, because it's one of the top questions we're getting as we start 2021. While some sectors and companies may have stretched valuations, we don't believe this is the case for the overall market. With interest rates so low, elevated equity valuations like high price to earnings ratios are to be expected. If you were to consider equity risk premium, which is excess expected return one will get by investing in equities over bonds, that does not look out of sync compared to historical levels and definitely not in bubble territory. Now, if you were to see a sharp move higher in realized inflation, that would result in a hawkish surprise from the Fed, and this could upset the market, but we're really not there yet. So with this backdrop, we recommend that clients look through some of the near-term uncertainty and diversify into segments of the market, the cyclical parts of the market that are likely to drive returns going forward.
Okay, great. Thanks, Salita. Barry, let's turn to you. We've got a new president about to be inaugurated in a couple of weeks. We've got the results of the Georgia Senate races shifting the balance of power in Congress. So with those political dynamics changing, what are the sectors of the economy that you see benefiting from a new administration, and why do you see that?
Thanks, Tom, and great to be here. Good afternoon, everybody. Look, I think 2021 is going to be a very difficult year to separate the impact of a new president and a new administration from the evolving picture on the virus. And if we cast our minds back to 2016, there was a lot of volatility in the market at that election cycle as well. We had a huge pop in financials at that time, but that sort of eroded away, and it eroded away and gave way to the secular forces. So I think it really makes sense for us to think about focusing on the structural dynamics at play that this administration may lean into in order to identify winners and losers. Now, the Senate shifting to the Dems is enough to support a progressive policy agenda, but again, nothing too extreme. It's nothing like the blue sweep that we were talking about a couple of months ago. And I think this progressive policy agenda is likely to be supported by moderate Republicans. Now, there are a lot of jobs that have effectively permanently disappeared as a result of the crisis that we've been going through. And the cost of debt is obviously extremely low. So it's kind of the perfect time to engage in infrastructure spend as a way to both modernize and to put people back to work. So I think we're in a bit of an arms race where we in the US are behind both on green technology and 5G. So these are areas where stimulus can be best directed, and both communications and industrial infrastructure parts of the economy should do well. And I think from just moving outside of the economy, just thinking from a markets perspective, what you want to find, and this dovetails with what Salita was saying, you want to find cyclicals that still trade at cyclical valuations, but have secular dynamics behind them. When it comes to areas that might be vulnerable, I think it's very hard in 2021 to pick a sector. We sort of echoing again what Salita was saying, 2021 is a year where we want everyone to do well. We want everything to get back on track. There's been a lot of talk about how well technology companies have done in 2020, and there are things maybe to dislike about some business models there. But I don't think there's the appetite to pick a fight in 2021 without a major backing to do so. So I think that this is going to be either areas do fine or areas do well, so long as we stay on track. And I'm sure we'll get to the sort of curveballs that could come into this. The one sector of the economy and the markets that I think is particularly interesting is broadly the healthcare sector, but actually specifically the drug sector. Historically, pharma companies have been very, very easy targets due to some of their pricing practices. But what's persistently poorly understood about the drug industry, that its pricing practices are versus the next alternative standard of care. And now I don't think it matters whether Pfizer or Astra or any of these companies ultimately make money out of developing vaccines, but they have been the proverbial cavalry this crisis. And the US government has put enormous, almost blind faith in these companies coming up with a technological response, and they've delivered in record time. So I think on a multi-year basis, there is a dramatic shift in how we should perceive some of these companies, because they're very much in the good graces of government. I think this can lead to significantly higher multiples, particularly given what we've discovered now that they're able to respond in this sort of new era of drug development.
Great, thanks, Barry. So, Salita, earlier you talked about the interest rates and the likelihood of us seeing lower rates for the foreseeable future. That typically is positive for stocks, but certainly for savers and investors, it makes it a lot more challenging for them to get yield out of bonds and cash. So how should investors be thinking about income and liquidity in the years ahead?
It is certainly more challenging, but even in a low yield environment, we see interesting opportunities to generate income in portfolios. But frankly, it would require investors to get a little bit more creative, and for US clients especially to look to international markets for additional returns. I would say one area that we find particularly interesting is senior loans, which offer attractive floating rate coupons with low correlation to other asset classes. Senior loans also have higher recovery rates than high yield and should also benefit from a broadening in economic activity this year. With about over $17 trillion of negative yielding debt, most of which is concentrated in developed markets and is likely to grow with more stimulus, we think that emerging market dollar-denominated bonds, especially sovereign bonds, offer compelling yields at around 4.5%. Going forward, though, we think that most of the return will come from the coupons rather than from spread compression at best. We also think that private markets can help to enhance the yield component of portfolios. For investors that are willing to take additional illiquidity and credit risk, private markets can provide enhanced yield opportunities through direct lending, core real estate, or infrastructure funds. And as Barry mentioned, with a renewed focus on infrastructure, we might see more opportunities there. And I would say finally, investors can generate additional income through value and dividend-oriented equities. This is one of the reasons why we are also constructive on emerging market value stocks, right? Not only should emerging market benefit from a broadening cyclical recovery, but also emerging market value offers a dividend yield close to 3%, an attractive option for those looking to enhance the income generation of portfolios while maintaining equity exposure. So some opportunities exist even in a low yield environment.
Okay, thanks, Salita. So Barry, throughout the pandemic, you've had policymakers trying to reduce the risk that what was a public health crisis, that it to try to prevent that from becoming a financial crisis. So as we think about the health crisis, unwinding and coming to an end as the vaccines distributed, maybe we start to see these fiscal and central bank tailwinds turning into headwinds as governments and central bankers start to unwind some of those policies. So maybe what are some of the policies or policy reversals that you're anticipating, and how do you think those are going to impact investors?
So, Tom, I hope that we and policymakers have received a good dose of humility over the last many months as it pertains to this virus. And I'm sure that Dr. White will attest probably still to how little we know about this virus. And certainly the increased transmissibility of the latest mutation was not forecast. I was actually supposed to do this call from Dublin, but actually canceled it because the system over there is being overloaded. So I think that because of this, you think about comparing and contrasting this with 2008. In 2008, that was a crisis that was brought about in the financial sector. It was something that effectively policymakers had been trained in. And while they had to respond dynamically and use new tools then, it was within their wheelhouse. This is totally outside of their ability to handicap and predict. And as a result, I anticipate that they will be very conservative in withdrawing stimulus. And I think what you have is very interesting evidence from March this year. When markets went into a funk, as cases particularly in New York were escalating dramatically, the 2008 playbook was rolled out in record time. Remember, it took 6 months to enact many of these things back in 2008. It took 6 weeks for these things to happen. And gaps that weren't, things that were exposed then that were not necessarily related to the 2008 playbook were immediately solved for. So I think that policymakers have gotten this lesson that in some ways it's kind of an up like mercury and down like molasses. You want to turn the stimulus spigots open. You want to open the spigots very, very quickly and close them very, very slowly. So for 2021, I'm really not anticipating much of a change there, given all of these dynamics. And I think for real change to take place in the investing landscape, you're going to have to get to the point whereby the demand for money structurally exceeds the supply of money. And to do that, we're going to need, it's almost like a case of needing a multi-year, full-blown, coordinated reinvestment project by governments globally to do this. Now, this could easily come if countries plan to honor their 2050 and 2060 zero carbon targets, but it's going to take years for us to get to that point. So I think, given this, and for the foreseeable future, I think the companies and consumers will continue to be net savers, and that's going to keep the investment landscape pretty favorable. Most notably, as Salita talked to earlier on, I think for equities where you have much fatter margin of safety.
Okay, great. Thanks, Barry. I've got a question now for both of you. We'll start out first with Salita, and then Barry, turn to you. Given what we see in the economic and policy backdrop that we've been discussing, what's the one specific opportunity that you'd like to highlight that you find to be particularly attractive right now?
Small caps. So I'd say our preference for developed market small caps is what I find to be the most attractive opportunity right now. Small caps are more geared toward an improvement in economic growth and should benefit as vaccines are rolled out and economies reopen. For this reason, we expect small cap earnings growth to outpace large cap throughout this year. But it's also important to point out that, small caps also provide an interesting way to diversify some exposure out of large cap technology companies into smaller tech-oriented companies, right? Small caps are well diversified so that investors can benefit from a reflation trade while also capturing secular growth dynamics. From a valuation perspective, small caps continue to look attractive even after the strong performance that we saw in the fourth quarter and yesterday's 2.5% rally on the expectation of greater fiscal stimulus in the United States. Currently, developed market small caps trade around a roughly 30% price to book discount. So 30% discount relative to their historical average of 18% discount against the large caps. So for these reasons, I think small caps offer an interesting opportunity right now.
Okay, thanks, Lita. Barry?
Tom, I'll try and be quick, but I need you to indulge me. I've got two. The first, I think, is all things China, frankly. And there's a whole bunch of technical stuff going on with the OFAC developments over the holiday period. But the Chinese economy has recovered. It stands in stark contrast to what has been going on in the Western economies. They've handled the virus period very well. That's going to lower the discount rate. They've been fiscally prudent at a time when we are all fiscally profligate. And yet yields across the fixed income stack there are very attractive from a global perspective. And I think we're also at peak geopolitical angst with respect to China, given the change in the administration. And this is sort of compounded by the fact that there, across all of the clients that we talk to, there continues to be this massive structural underweight there. So I think that's the major one that I think our clients need to be focused on. The second one is slightly more thematic, and it's really this concept of experiences over things. We had been in a 20-year bull market of experiences over things, and that has been cauterized dramatically in the last 12 months. And if you look at all of our personal spending, it's gone in completely the opposite direction. And I think that there is a combination of massive pent up, a massive recognition of the value of these things. And that is not reflected in either the credit spreads or where debt is trading or where the equities are trading associated with these type of experience oriented things. And I think they're going to go into overdrive when things recover here. So I'm really bullish on a reemergence of that trend.
Okay, great. Thanks, Barry, for that. We've covered, with both of you, your views on the markets, policy, the economy. You gave some opportunities that you see. Maybe let's flip it around. What's a key risk that could challenge the views that you've expressed? Barry, we'll start with you, and then Selena, we'll let you have the final word.
Well, look, last year I mentioned this concept of an environmental catastrophe, this sort of curveball, and I bring it up again largely because there is a connection between what's going on in climate change and the growth rate that we're having in the number of infectious diseases and proliferation of viruses that's taking place. But I bring it up specifically here because we are dealing with an incredible tax on the global economy. And if some curveball like that were to materialize at the same time, you'd be dealing with two of these things and it might break the system. So park that. But the more obvious one that I think everybody is focused on, particularly recently, is this concept of further virus mutations. We know that COVID-19 is mutating at a faster and more unpredictable rate than prior coronaviruses. I defer to Dr. White on this, though, but I may not know a lot about viruses, but I think we all know a lot about confidence. And if it really were to come to pass that a virus mutation were to manifest itself that was not easily resolvable with the current vaccine technology, that will be the day. I don't mean to be too artistic about it, but that will be the day that hope dies. That would be the day that you would have a once in a generational shock, I think, to equity markets and risk assets. But, and I make this point, that is also the day that expectations get completely rediscounted. Because at that point in time, investors will say, this is now a permanent problem. We have to assume that X% of the global population gets wiped out. Remember, 5% of the global population got wiped out in the influenza pandemic. And that had, so it was a very significant reset to GDP, but that becomes a reset to GDP, and then you get herd immunity, and then you get normalized growth. So it ends up becoming an incredible investing opportunity at that point in time. Can't tell you what the probability of it taking place, but you need to go full bore at that point, because you're almost guaranteed, given all the things we've talked about before, that stimulus stays super accommodative for a very long period afterwards.
Okay, Salita.
So we're going to spend quite a bit of time with Dr. White on vaccines, so I'll start with that. So I do not see vaccine rollout to have a significant setback after this point for the markets. 2020 threw us both Corona and a very contested election. Just because we're coming out of a period with many unexpected developments does not mean 2021 will have a similar black swan events. I can count a few low probability events, such as the virus mutation, further social unrest as potential problems, maybe short-term problems for the markets. But I think expecting another year like 2020 would be unnecessarily pessimistic.
Okay, great. Well, Salita, Barry, thank you both. What I want to do now is bring Dr. White into the conversation to pick up a bit on what Salita and Barry just discussed, to talk very specifically about the vaccine. So, Dr. White, as Salita just mentioned, the vaccine's a big factor in the speed and the size of any economic renewal. We're starting to see that healthcare workers and vulnerable populations are starting to get allocated the vaccine. That's great news. At the same time, we've also heard about the fact that it doesn't seem like we're distributing as much as we would have hoped at this point in time, maybe due to some supply chain or distribution issues. So, what's it going to take for us to have 300 million Americans to get the vaccine, and when do you see that happening?
Well, thank you, Tom, and good afternoon, everyone. The vaccine really is the strategy that we need to use to crush the pandemic. So, as of today, we have given out about 5.5 million vaccine doses. The goal was 20 million at the end of last year. So we've missed our mark. But the good news is there's still time to do a course correction, and I think we're starting to do that. As of yesterday, 200,000 doses have been given a day. But as Dr. Fauci points out, we really need to be at a million doses a day. And it was announced that pharmacies are going to start administering the vaccine. So CVS recently announced that through their 10,000 pharmacies, they're going to be able to do 20 to 25 million vaccinations a month. Now, keep in mind that the currently 2 authorized vaccines by the FDA, Pfizer and Moderna, are 2-dose regimens. Johnson & Johnson will likely submit an EUA request in February. We're hopeful that's going to be a 1-shot, although they still are testing a 2-shot as well. So if we can get to 1 million doses a day at least, I just want to give you a timeline based on some numbers, because I think it's good to look at the math, and instead of just prognosticating, if we're at 1 million doses a day, if we're on phase 1, because the issue really isn't supply, it's distribution. We do have enough vaccine. We're going to have another 50 million doses this month. So healthcare personnel in long-term care facilities, 24 million people. If we look at frontline workers and persons over 75 years of age, that's 49 million people. So that's, if we're doing 1 million a day, that's 7 weeks. If we move to 1C, which is persons 65 to 74, people with comorbidities, that's about 129 million people. So we're talking, maybe it's 15 to 20 weeks, depending upon if we can expedite more than 1 million doses, and then the rest of the population. So the reality is those that don't meet any conditions may not start until June, maybe July, sooner if we could rev it up. I recently have been talking about, do we need to bring in the National Guard? They're good at logistics. They're good at mobilization. That's what we need. When we're talking about having the healthcare system do it, and I'm a health provider, as you pointed out, everyone already has a job. So the people that are registering us, the nurses, the pharmacists, they had other jobs. We really need to think about the distribution. But the good news is we do have time to do a course correction. So 200,000 a day now, we were probably at 20,000 a couple of weeks ago. Can we get to 1 million or more? I think we can, especially as we bring in the pharmacy chains and start to think about other mechanisms to do it. The challenge is we haven't had much coordination that we need at the national level. I'm hopeful that's going to change next month, where we'll have greater coordination, because we can't have some areas of the country where people are waiting in long lines and other areas of the country where vaccines are sitting on the shelf. So it's a distribution mechanism, which I think we're going to correct. But the reality is we're really talking about probably mid to late summer till we have a good percentage of the population vaccinated.
Okay, so as the Chief Medical Officer, WebMD, I'm sure you get a lot of questions about how safe is the vaccine and whether people should get it right away. So what are they concerned about? And maybe flipping it around, how concerned are you about a potential lack of adoption in the early stages of the vaccine rollout?
You know, I used to joke, everyone is saying they want to wait and see how other people do. Well, if everyone waits, that's going to be a huge challenge to herd immunity. And I will fully acknowledge I got the vaccine last week as a healthcare worker. I didn't have any concerns. When it was my turn as a healthcare professional, I said, I'm ready, and I got the Moderna vaccine, and I'm glad I did. But I think the issues come around. People are concerned, as you point out, about safety. And in some ways, I think it's been a communication failure that we need to address, even calling it Operation Warp Speed. So people will say, it's too fast, I'm worried. But it's to Barry's point, where we've had tremendous innovation. And that's what we should be celebrating in terms of the pharmaceutical and life sciences industry has stepped up to the plate and delivered. And we were able to sequence it in February. And then the reality is, as you know, the federal government basically said, I'm going to buy this product no matter what. When do we ever have that type of arrangement? Who wouldn't create clinical trial design? Because I'm going to buy it, and if it doesn't work, I'll just discard it. There's no risk for the company to do it. And then the reality is, because we had a lot of virus in the community, we were able to enroll persons and see those differences between vaccination and the control group. So it wasn't a situation where corners were cut. It's one where we can celebrate innovation. And I think that's been the biggest challenge. And we're not explaining it well. People will say, well, it's only been 2 months. That's usually the data that the FDA requires for vaccination. There's nothing different. And people still ask me, well, why is there a 2-dose regimen? We have that in multiple vaccines. We have it in shingles, we have it in HPV, we have it in hepatitis. That's not unusual. And I think it's something we're starting to really work on at WebMD with other partners. How do we communicate that messaging to persons? Because if we don't have adoption and people get the vaccine, that's going to be a real concern, because we won't reach that herd immunity where we have protection and can return to normal.
So Dr. White, clearly in what you've been describing, we've seen the miracle of modern science. But what concerns maybe do you have about the vaccine in terms of how we get it through the population? Is it the things we mentioned before about trust? Is it distribution? Is it issues about long-term effects, or maybe how long immunity lasts? Like, what are the things that you're thinking about as a medical professional?
How long it lasts is a concern. And we've had a bunch of conflicting information, whether it's 6 months, whether it's a year, whether it's 2 years. It's to Barry's point, it's a novel coronavirus. So there's still a lot we don't know. And we should acknowledge that. But the reality is when we weigh risks versus benefits, we need to take as much protection as we can, even if we don't know the timing. I don't think that's going to be as much the concern as what we see, a disproportionate impact that we saw on minority populations. That's what we're starting to see in terms of adoption, that they want to wait or they don't want to take it, or it's not that serious. I've been asked many times, can it alter my DNA? And I sit and explain to patients and talk about, well, first of all, it's an mRNA virus, but if we explain how it works, it provides a bit of genetic code and it tricks our body into creating antibodies to that spike protein. It delivers a message, and then the message is destroyed, almost like, remember those Mission Impossible movies where they'd say, if you accept this message, it'll self-destruct. It can't cause any harm. I think the challenge that we've been having, Tom, is in some ways in the medical community, we talk down to patients when they express concerns about vaccinations. This isn't new to COVID. And we tell them their concerns are not reasonable, or we just dismiss it. We need to be good listeners. We need to have an aggressive strategy of people that look like you, that are taking it and say they're doing okay, and really helping them make that risk calculation. Folks, this, aren't typically good in math. And how do you weigh that risk in terms of how do I protect myself? How do I protect my family and my community? Otherwise, we're just going to limp along for several more months, and nobody wants that. I think once we improve the distribution mechanism and people see other people like them getting the vaccine and doing okay, and the hope to return to normal, I think more people are going to get on board. We might not be 90%. I know Dr. Fauci has increased his numbers a little, but I do think we're going to get to that 70%, which is really, that would be tremendous in terms of getting back to normal.
So let's look ahead a bit into the future of medicine. Do you think that there's now a new precedent for drug testing and approval timelines with the FDA, or was this really a one-time thing because of the pandemic?
And you mentioned I worked at FDA. In full disclosure, I worked at FDA for 5 years in the center director's office, and you may be aware that last year, year of a pandemic, 53 new molecular entities were approved at the FDA, the second highest amount in 20 years. Maybe that's what happens when everybody works at home. I don't know, but that is impressive when you think about the resources of the FDA being devoted to COVID, not just in terms of biologics, but also therapeutics and testing, multiple centers at the FDA. So it really was a use of the emergency use authorization authority, which says weigh the risks and benefits differently when it's a public health emergency and there's no alternative therapies. So the reality is that's what the FDA did. But in terms of most of the other drug approvals, they're actually, for the last few years, have been done under expedited pathways. The majority of drugs are. So I don't actually see that, to be honest, that it seems to everyone that it was done in record speed and it was done quickly. But we're seeing that more and more in terms of FDA meeting PDUFA guidelines and really approving a large number of drugs in record time. And I think the FDA deserves credit for that, especially in a year that no one could have imagined. And I think we're going to continue to see record approval times.
That's very encouraging. So, as part of our UBS's year ahead outlook, we talked about some of the next big things, and we were highlighting disruptive trends and sectors that we think would have really attractive long-term returns for investors. And one of those key areas is health tech. And maybe you could talk a little bit from your seat as a chief medical officer, how have you seen technology evolving within the healthcare space during the pandemic?
We've been talking about digital health tools for a while, but this is the year where it truly has accelerated and taken off and going to cause permanent change in a good way to the ways that healthcare is delivered. And mostly it's about truly bringing care to the patient. And we're all talking about telehealth and telemedicine, but it's much more than that, where we're using wearables much more, sensors, trackers, collecting real world data. We've been doing clinical trials in the home that we never thought that we could do before, partly because of some regulatory challenges. We're doing cancer chemotherapy in the home as opposed to always having to go to clinic. I think we're going to see much more of this approach in terms of bringing care to the patient. There's that expectation now of consumers. Why should I, have to go to the doctor's office when I have a concern? I can order everything online, never have to go to the grocery store. I could do curbside pickup or they can deliver it. So in many ways, those expectations in retail are turning to the same expectations in healthcare. So if I have a mole, why should I wait 6 weeks to go see the dermatologist? I can download an app, I can pay a small fee, and I can get a read that same day. At WebMD, we saw people search content, they search joint pain. They want to see a rheumatologist right now. Why should they have to wait to the morning, call and ask for a referral? I think we're going to see more and more of that, including kind of this DIY approach that patients want to manage the care themselves. And we're going to have to acknowledge we're not going to be able to have as much investment in resources in healthcare. So we're going to have to weigh whether we invest. I've been talking about these lasers that can detect your heart rate and heart signature from afar. So I could identify who you are. But how is that going to help clinical expertise? As opposed to, I've talked about this, there are now these toilets in development where it actually monitors your stool and your urine on a daily basis, looking for blood in your stool, possibly colon cancer, could also be, hemorrhoids, analyzing your urine for perhaps a urinary tract infection that's developing, or perhaps ketones, that could be a sign of diabetes. That's where I think the future of health is going to be, quite literally. I'm going to say in the toilet, but in a good way. But the principles are that the consumers are going to manage their care. They're going to have much more of a role, and they're going to purchase products. They're going to help them have greater say in their care. And those are all going to be good things that are going to improve people's health.
So, Dr. White, to tie this up in a wrap-up question for you, certainly COVID and the pandemic has caused a tremendous amount of fear and worry, and that's for good reason. But it is the start of a new year, hopefully, a new chapter for the pandemic. What gives you hope for renewal and optimism in 2021?
I look at where we are today, roughly to where we were last year. And if you think in the period of 9 or 10 months, we have brought 2 vaccines to market. We have multiple other vaccines in the queue for approval around the world. We have multiple therapies. We had nothing at the beginning. Now we have remdesivir. We have monoclonal antibodies. We have multiple other therapies that are under investigation. We spent a lot of time on vaccines. Operation Warp Speed is working on 150 different candidates for therapeutics. And look at diagnostic testing. Although it's been iterative and there's been some bumps along the way, now we're talking about at-home testing. We're talking about much more accurate rapid tests, including rapid antibody testing. So I'm very hopeful in terms of look how much progress we have been made. It has been painful. There's been an acceleration of cases and hospitalizations even recently. But the big difference, Tom, is I feel like we can see the light at the end of the tunnel now, whereas we couldn't do that over the summer. And I can say we have a vaccine, we have therapeutics, we have an ability to do much more testing to return to normal. So that's what I'm optimistic about and hopeful about. And then I think we're going to get there. I feel like we have a strategy and we're developing a strategy, and we didn't have that before.
Well, Dr. White, I know, certainly being a medical professional in this environment, you're extremely busy. We really appreciate you taking time out of your day to spend it with us, today. I also want to thank Salita Marcelli and Barry Gill, and to everyone who's been able to listen to our discussion. We appreciate you spending your time with us, and for the trust and confidence that you place in UBS and in your financial advisor. For more insights about what 2021 has in store, please visit ubs.com/year-ahead. So again, thanks to everyone for joining. Stay safe and healthy. Best wishes for the new year, and have a great rest of the day.